Thank you very much for the invitation, and thank you to everybody for being here this morning. I just want to start with a little story, if I may. A few years ago, I was at a conference of economists, as you do, and the chairman of the conference stood up and said, well, we as economists have a bit of a problem. We don't want to be wrong. We don't want to be wrong because we got the financial crisis so wrong that we're actually really scared about predicting an upside now. So even though, and we're talking 2010, 2011, even though the growth was fairly rapid at that point, economists were predicting dire things ahead because they just didn't want to be wrong. And you're more likely to be right if you predict terrible things than if you predict good things. So maybe it's because we're a miserable bunch of people. It's not called the dismal science for nothing. Or maybe there's something in that. In actual fact, economics is almost powerless at the moment to predict what's going on. It's very difficult to look into the future when you have things happening like the UK election, when you have things happening like Donald Trump, when you have things happening like Brexit, and even Grenfell Tower in the last couple of weeks. And all of this has created an environment of uncertainty that is the framework globally, but it's also the framework very specifically for the UK economy. And you can start any way you like on this picture. You can start with sterling's value. Sterling's value is a function of instability at the moment. It's particularly political instability. It's also been a function of Brexit. It's also leading potentially to affect our economic growth. Are we going to see changes in fiscal policy? Are we going to see changes in quantitative easing and interest rates? Will we see a return to the new normal? And then there's huge political uncertainty as well at the moment, the UK being one of the least stable developed nations in the world at the moment. All of this is having a vicious circle effect, and it's creating more uncertainty. And this is a business climate that you are operating in at the moment. But I guess I'd raise that question. Can we trust the experts? So everything I am about to say is caveated with that question. Can we trust the experts? So what I want to do is give you an overview of some of the things that are putting pressure on the UK economy, and then you can make up your own mind about whether or not we can trust the experts. So the policy context at the moment, and forgive me for dwelling on this, but it is the most important thing. My fundamental argument is that politics at the moment is, in a sense, more interesting, but in a sense as well, more important than the economics of what's going on. But there are some very real electoral concerns and some very real business concerns that are affecting the way in which people are voting. We can see that. We've just been through a general election. So let's run through some of those things. From an electoral point of view, there's a real need. There's a real soundbite that's beginning to come through, and Jeremy Corbyn seems to have picked up this zeitgeist to loosen the economy a little bit, to have a little bit of fiscal loosening. We've got sluggish GDP growth. House prices becoming a lot softer. I'll show you some data on that. Real wage growth is also not performing in relation to other areas. And particularly as inflation rises, that's an issue. And we've got very high levels of household indebtedness. And the report yesterday by the Bank of England on financial stability again raised that as a major concern that the Bank of England is worried about. And on the business side, we've got things that have been problems since the financial crisis, but there are also perennial problems for the UK economy. So productivity, big one that's out there. Is the UK economy ever going to escape from the productivity gap that it has, particularly with the US and with France and Germany? Some of that is about skills, some of it is about investment, some of it is about the circumstances that we find ourselves in as a very open economy. But nobody really seems to have the answer, and you can actually go back to 1872, where there was a Royal Commission on Skills, to see that we've had a problem with productivity for a very long time. Quantitative easing and interest rates, what's going to happen there? Last week, again, we were shown maybe a hint that things might change, but I'll give you some ideas on my view on that in a little while. And then the value of sterling. Which way is the cookie crumbling at the moment? Is monetary tightening pushing our seesaw, or is fiscal loosening pushing our seesaw? big conflicts that policymakers have at the moment. And let me just run you through some detail on all of that then. So if you look at UK GDP growth, over the last 10 years, really, there's an obvious dip in the financial crisis. But if you look at how GDP has grown, actually the line is relatively flat. And if you look into 2018, it's going to be slightly flatter still. So we're not looking at major GDP performance or major GDP uptick. And in fact, most of the major economic forecasters at the moment are predicting that GDP will slow into 2018. But alongside that, and this is where one of the paradoxes is at the moment, we've actually got per capita GDP, in other words, average GDP, the money you have in your pockets. That has actually grown. So over time, since 1995, it's grown, but it's also grown since the financial crisis as well. And what that's doing is it's creating a sense that there's a bunch of haves and have-nots, which is giving rise to the populism that we've seen that both determined the Brexit vote and arguably the UK election vote as well. And let's add another layer to the confusion amongst the electorate at the moment. Real earnings aren't growing at a rate that allows them to keep up with rises in prices. So inflation is growing. It was 2.9% last month, and we're beginning to see greater inflationary pressures. Although those might well dampen into 2018, the problem that we're seeing is that inflation is outstripping real wage growth. And the tendency from that is obviously to say, well, consumers still seem to need to spend money. We've seen retail sales continue to increase. So what's the logical consequences of that? Well, in actual fact, it's that borrowing is also increasing. We're still seeing house prices high as well. Come back to borrowing in a minute, but we're still seeing house prices high relative to real earnings. This is a problem for people wanting to get onto the housing ladder. And again, although there are signs that this is softening a little bit, and certainly the British Bankers Association data that came out earlier this week suggests that people aren't borrowing as much on their mortgages, but there's a chicken and egg thing there. Is it house prices are softening, or is it people becoming more cautious about borrowing? I suspect it's actually house prices that are beginning to soften, but they're still too high for people to get onto the housing ladder. And this is a real concern. Consumer credit, it's a real concern to everybody in this room, but it's a real concern to households, because households themselves are wanting to buy. As I said, we've seen retail sales increase again. They dipped last month, but they've gone back up again this month. And the concern here is that people, because their real earnings aren't growing, just bung it on credit cards. And we've seen all of the debate over the last week about credit cards and about car sales and about used car sales and credit deals with used cars. And the Bank of England actually listed that as those used car credit deals as part of their concern. They're saying that actually the financial sector, and it's not just banks, it's cards companies as well, are actually being a little too loose with the loose interest rate environment at the moment, and as a result, taking risks with consumer credit that maybe they shouldn't be taking. And that creates an instability. It creates a risk of default. And obviously the report yesterday said, well, we're going to increase capital buffers in order to make banks a little bit more cautious about the way in which they're lending. So what's the outlook? Well, I've already hinted at this to some extent. I'm an economist, so I'm taking an average of everybody else's forecasts rather than my own, because you can't trust experts, but maybe you can trust a mass of experts. And this is actually the Treasury. What they do each month is they put together a forecast of forecasts. So they take an average of all the forecasts and probably mess around with it somehow or the other so that we can see what all the major independent forecasters are saying at the moment. And the picture's quite clear. Seeing reasonable growth this year. It's slower, 1.7%, around that, but slowing into 2018. Reason for that, higher inflation this year. Again, inflation slowing a little bit next year, but that's going to create inflationary pressures, slow consumer expenditure a little bit as well. Big difference in this chart, actually, between this year and next year is public sector net borrowing, 61.4 compared to 49.4. Big big contraction in public sector borrowing planned there and working through the forecasts. And this has all been part of the austerity budgets, if you like. This is something that we may see some changes in over the next few months. But if you look at unemployment, forecasting about 5% unemployment, it's still very, very low, rising slightly in 2018 to 5.3. So all the major indicators are changing. Higher inflation this year, lower inflation next year, higher growth this year, lower growth next year, higher public sector borrowing this year, lower public sector borrowing next. So they're kind of mixed, and actually we're still seeing growth. So the economy is not a bad news story, but it's just based on sand at the moment rather than cement. So let's have a look at what some of the policymakers might do and that might change your decisions when you're making decisions about whether to invest in a country or keep your resources here. What happens to interest rates? What's going to happen to interest rates? So last week, and over the last couple of weeks, we've seen a lot of debate around this. The Bank of England has kept interest rates on hold. I'm of the view that they will keep interest rates on hold, right? I've said it, I'm an expert, don't quote me on that. I'm not alone in thinking that. I think a lot of people are saying, well, actually, here are the reasons why. Household demand is too weak, household indebtedness is too high, there are too many uncertainties in the political environment at the moment, and straight after the election, the one thing that happened was everybody came out and said, no way interest rates will change this year now. A week later, the Bank of England voted 5-3 to keep interest rates on hold, and suddenly Nomura, for example, are coming out and saying, actually, we think interest rates might go up this year. Who knows? But I think on balance, if you look at the evidence and you look at the data, which is quite weak, then it's likely that interest rates will stay on hold. And I go back to the Financial Stability Report of yesterday. One of the things that's happening in the UK and happening within UK monetary policy is it's not necessarily being run by the Monetary Policy Committee anymore. The financial stability reports and the macroprudential measures, for example, capital ratios, are being used to stabilise the economy far more. And that has been the case since the crisis and certainly been the case since the referendum. And I think we might see some more proactive macroprudential policy, in other words, keeping capital buffers higher. Sterling is helping our current account deficit, and it also helps to keep equity prices high. So actually keeping interest rates where they are at the moment is not going to affect sterling because those are being blown about by other things, particularly politics. So the real problem we have, is there going to be a bolt of lightning where rates suddenly go up? The problem that the Bank of England has at the moment is this balance between household indebtedness and the fact that profitability, particularly in the banking sector, is low, but we've also got a pensions problem, we've also got a savings problem. And I think that's there's almost no sense of wriggle room for the Bank of England at the moment, which is why macroprudential policy might be more important. Will there be a fiscal boost? Again, a lot of rhetoric around this, and I've already said that populism says that there might be some kind of move away from austerity. But if you look at what's already been baked in, there's a lot of infrastructure that was baked in the budget, in the last budget. And the government has, over the last few years, been very reluctant to borrow, even though we have historically low interest rates. It gives that there may be some tinkering at the edges because there is a populist demand out there for something to be done. You could argue, and this is a very political statement, so I apologise, you could argue that the deal with the DUP is in some sense a fiscal boost to Northern Ireland, and that other parts of the UK will start asking for similar types of things. But in real terms, I think the probability of a substantial fiscal boost is actually quite low because the government's main objective, ever since it was elected in 2010, has been to bring public borrowing under control, bring the deficit under control. We don't know what the new government's priorities are going to be, but I suspect they will still stay the same, and we have near-term inflationary pressures, which will also mean that the government will want to keep tight hold on fiscal measures. So we don't know what the costs of Brexit are going to be either, and that's very important because Brexit might cost the economy an awful lot of money, and so something needs to be kept in reserve. And again, all these factors mitigate against a substantial fiscal boost. Will the value of sterling help out? It's bound up with politics, and there's been a lot of debate again about the value of sterling. It helps exporters a little bit, but the correlation between the value of sterling and our exports is actually very, very weak indeed. So if you look over a 20-year period, it's only 0.2%. In other words, there's a tiny correlation between the value of sterling and increases in exports. And our trade-weighted index is very similar to what it was at the financial crisis. So in actual fact, we're in a very similar situation to where we were back in 2009. There's been a spike as we started to grow more quickly. Investors are now a little bit more nervous. And post-referendum, it does seem to me that markets are pricing that uncertainty in and actually trading at a lower value of sterling. And in the end, I'm going to spend the last 5 minutes talking about Brexit because I have to, because it's out there and it's irresistible. Has the election changed everything? Well, people with political backgrounds can say an awful lot more on this than I can as an economist. But it does feel as though the mood music has changed slightly. It does feel as though the imperatives to have a transition arrangement are beginning to be heard. And let's have a think about why the UK needs to have a very sensible look at Brexit and what this actually means in 5 years' time. Trade really matters to the UK economy. There's absolutely no way around it. We are one of the most open economies in the G20. We're actually not the most open economy in the EU. We're one of the mid-ranking ones in the EU. But 42.3% of our GDP is accounted for by trade. So we are an extremely open economy. France, Canada, South Korea and Germany have higher ratios than us, have higher exports and trade as components of their GDP, but it's still very high. We rely very heavily on trade. Now, I've already said that things in the economy are a little bit more positive, and globally it looks like demand's picking up. So if we look at where the sectors are, where, having said you can't forecast, these are Equant analytic projections, but they're projections, so they're trend projections rather than forecasts. But if you look over the next few years, what we're saying is that optical and photo precision equipment, electrical machinery, pharmaceuticals, aircraft, automotives, they're all going to grow, and these are key sectors for the UK economy. So the areas where we have strength are all looking like demand is growing globally. Where we've got weaker growth is actually in mineral fuels and organic chemicals. So there is possibly a slowdown. That just suggests that oil prices and commodity prices are going to remain relatively static or possibly low. And again, to reiterate the importance of those sectors, they're not just important for the UK, they're also important for Europe. And this is why there has to be, at some point, some kind of compromise. Everybody has to step back from the table and say, right, let's stop this brinkmanship. We need to compromise, because if you look at Europe's exports to the UK, automotives, machinery and computers, pharmaceuticals, electrical equipment, then we have our exports, UK exports to Europe, and they're in very similar sectors except oil and gas. And then we're looking at oil and gas exports from the EU into the UK. And again, you've got the same sectors appearing. Why does that matter? It's because they're all bound up with European supply chains. So this is not about the UK trading with the EU. This is about the EU having the UK as an integral part of its supply chains in some very important strategic sectors. At some point, negotiators have to realise the strategic importance of all of that and sit and talk about it. And again, you can see how concentrated these sectors are. It actually accounts for these sectors, those routes that I've just shown you, account for over 40% of the trade between Europe and the UK. And they're highly correlated. Trade between the two is highly correlated with the value of the euro. So Europe is going to be thinking, right, we've got to do this, because if we're not actually trading with the UK, we're going to have some effects. We're going to see some effects on the euro as well. And I think it's very important that there is this very strong correlation. It's about 70%. And again, why is the UK in a fragile position? Because the outlook for services, generally speaking, is quite good. This is without Brexit. This is no assumptions built in. But the areas where we're looking at actually weaker trade is in some of the key areas which we like to export. So cultural and creative, franchises and legal services and trademarks, and then financial services. And that's where the outlook over the next few years, other things being equal, so just what's happening at the moment doesn't look so good. And those are areas which are also of strategic importance to the UK, but increasingly for Europe as well. So just to draw a few summary points together then. An outlook for the UK economy. The UK's economic prospects over the next 12 months, they're bound up with politics. It looks like there will be a slight slowdown. It looks like we will see an increase in inflation this year. It looks like that might slow again into next year. It's unlikely that rates will rise, and equally unlikely that there will be a significant infrastructure boost. I will caveat that with the fact that the Bank of England seems to be arguing with itself at the moment. So I guess the real point is there are unforecastable times ahead. And a final thought on Brexit. This is why it's impossible to tell what is going to happen. Is a Brexit compromise more likely? A minority government requires compromise, but there's no clear mandate for hard Brexit, again requiring compromise. There's scope maybe to lengthen the process, maybe not. Maybe there's a requirement for a degree of humility on both sides, the UK side and the European side. And I'll just leave you with the thought. Maybe it's time for experts after all. Thank you for listening.